If you own a home, especially one you bought decades ago and plan to use as your retirement safety net, you need to pay attention to what's happening in these 5 states because thousands of older homeowners are walking into massive tax hits without realizing it until the closing papers are already signed. And the worst part is, this isn't being marketed as a new tax on your home equity. Nobody sends a warning letter saying, we're about to take a large percentage of the value you spent 40 years building. Instead, it shows up buried inside surtaxes, transfer taxes, reassessment laws, estate thresholds, and capital gains rules that only activate the moment a long-held property is sold, transferred, inherited, or reassessed. By the time most retirees realize what happened, the money is already gone. So in this video, we're breaking down the 5 states where home equity is quietly being drained, how these taxes actually work, which homeowners are most exposed, and the exact planning moves seniors are using to reduce the damage before it's too late. Take a typical couple in their early 70s living outside Boston. They bought their home in the mid-1980s for just over $100,000. They spent 40 years paying it off, maintaining it, raising children there, and building their retirement around the idea that the home equity would eventually support them later in life. By 2025, the property market had exploded and the house sold for $1.8 million. To them, this felt like a normal retirement move. Sell the big family home, downsize into something smaller, and use the remaining equity to fund the next phase of life. At first, everything looked manageable. They already knew about the federal capital gains exclusion that allows married couples to exclude up to $500,000 in profit from the sale of a primary residence. They factored that into their planning. They expected some taxes, but they assumed the biggest hit would come from the federal side. Then the Massachusetts return arrived, and suddenly tens of thousands of dollars disappeared through state-level taxes they never anticipated. The numbers escalate fast. The house sells for $1.8 million. The adjusted cost basis after improvements sits around $200,000. That leaves roughly $1.6 million in gain. Subtract the $500,000 federal exclusion, and there's still about $1.1 million exposed. Massachusetts applies the standard state income tax and then layers the surtax on top because the gain pushed total annual income above the threshold. Suddenly, nearly $100,000 disappears from what the couple believed was their retirement nest egg. What shocks people most is that these homeowners don't feel wealthy. Their income may only be pensions, social security, and modest investment distributions. But the year they sell their home becomes an abnormal tax year, and that one transaction changes everything. Then there's Washington State, where many longtime residents assumed they were protected because Washington historically had no state income tax. That changed when the state introduced a capital gains tax and survived constitutional challenges in court. The law imposes a 7% tax on long-term capital gains above a certain threshold, and while primary residences are technically exempt, the exemption is much narrower than most retirees think. Vacation homes are not protected. Rental properties are not protected. Inherited homes that were never used as a primary residence are not protected. And that's where many older homeowners get caught. Someone who spent decades building retirement security through a second property or inherited family cabin suddenly faces a major state-level tax event the moment they sell. Washington also has another layer most sellers don't pay attention to until closing day arrives: the real estate excise tax. This is separate from capital gains tax entirely. It's built directly into the transfer process itself. The rates increase as the value of the home rises, meaning the more appreciated the property becomes, the larger the bite the state takes during the transaction. For someone selling a long-held property worth over $1 million, the excise tax alone can remove tens of thousands of dollars before the proceeds ever reach the seller's account. And because many retirees don't view transfer taxes as part of an equity tax, they fail to realize how much value is quietly disappearing from the sale. California presents an even more layered situation because there isn't one single mechanism draining equity. It's multiple systems stacking on top of each other over time. First comes the state income tax itself. California already has some of the highest income tax rates in the country, and capital gains are treated as ordinary income at the state level. So when a senior sells a home with massive appreciation beyond the federal exclusion, the excess gain flows directly into California's tax structure. A house assessed decades ago at a few $100,000 may now be worth over $2 million. Under the old system, children could continue paying taxes based on the lower assessment. Under the new rules, that same property can suddenly generate annual tax bills that are several times larger. Families who hope to keep a home for future generations are now discovering that the carrying costs themselves become unsustainable. Over the span of 20 years, those higher taxes can quietly consume hundreds of thousands of dollars in additional payments. There's also ongoing discussion in California around wealth tax proposals targeting high net worth households. While many of those proposals have not yet become law, the concern among homeowners is that once the framework for taxing net worth exists, thresholds can eventually shift downward over time. New York may be the most layered state of all when it comes to overlapping real estate taxes. Homeowners there often face multiple drains on equity simultaneously, especially in New York City. The first hit comes from transfer taxes imposed by both the state and the city. Sellers already expect some closing costs, but the combined taxes on higher value properties become enormous very quickly. Then comes the mansion tax, which technically falls on buyers but often reduces the negotiated sale price sellers ultimately receive. A retiree selling a long-time Manhattan apartment or Brooklyn brownstone may watch tens of thousands of dollars vanish simply through the transfer structure before even considering capital gains exposure. Then there's the estate tax issue. New York's estate tax threshold sits dramatically lower than the federal exemption. That means many retirees who believe they are nowhere near federal estate tax territory still end up exposed at the state level. Families who never considered themselves wealthy suddenly face state-level estate taxes simply because decades of real estate appreciation inflated the paper value of the estate. This becomes especially painful because property values in New York have appreciated so aggressively over time. A family home bought for a fraction of today's value may now represent the majority of the estate's worth. Attorneys in New York often focus heavily on trust planning because the structure and timing of ownership can dramatically change estate exposure. They also look carefully at when large transactions occur because stacking a major home sale on top of high income years can create even larger tax consequences. Then there's Minnesota, a state that became nationally known after a Supreme Court case involving a woman who lost her condominium over unpaid property taxes. The county sold the property and kept not only the taxes owed, but also the excess equity. The Supreme Court ultimately ruled against that practice, declaring that governments cannot simply confiscate surplus equity beyond the debt itself. But even after that ruling, Minnesota still presents major equity exposure through other channels. Property taxes themselves are also significant. Over a long retirement, homeowners can quietly lose enormous amounts of equity through annual tax burdens alone. Many retirees focus only on the home's value increasing while ignoring how much cash leaves the household year after year to maintain ownership. And despite the Supreme Court ruling, many families who lost equity before the decision still face complicated legal battles trying to recover funds. Once the sale closes, the transfer occurs, or the reassessment hits, options shrink quickly. One of the smartest first steps is simply conducting a records audit. Most homeowners cannot immediately produce improvement receipts, old closing statements, or basis documentation. Yet those documents become critical during any tax calculation. The second step is understanding thresholds specific to your state. Many people vaguely know taxes exist but have no idea where the actual trigger points begin. They don't know the estate tax threshold. They don't know the surtax line. They don't know how capital gains stack with pension income or investment distributions. Without those numbers, retirement planning becomes guesswork. Third step is identifying which filings protect equity in your specific state. Different states require different forms, deadlines, and occupancy rules. Missing even one filing window can permanently change the tax treatment of a property transfer. Then comes timing. In several of these states, recognizing gains across multiple years instead of one can dramatically reduce exposure, but that planning has to happen before the transaction begins. Once contracts are signed and closing schedules lock into place, flexibility disappears. Finally, many elder law attorneys recommend evaluating whether a properly structured revocable living trust makes sense for the family situation. Trusts do not magically eliminate taxes. For families with highly appreciated property, that structure can save enormous amounts over time. The biggest mistake homeowners make is assuming these issues only affect the ultra-wealthy. In reality, decades of appreciation have transformed ordinary middle-class homeowners into targets for systems originally sold as taxes on the rich. Someone who bought a modest suburban house 40 years ago may now sit on over $1 million of unrealized gain without feeling wealthy at all, and that's exactly why these taxes are catching so many retirees by surprise.